Now's the part of the show that I talk about what I think is important for individual investors to consider before you make your investment decisions over the next couple of weeks. A couple of my points here we've touched on in the past, but I think they're really important right now, and they remain important. One of them, or the first one I have here, is Fed speak, Federal Reserve, or the governors. A lot of them are speaking this week. What are they saying? Inflation data. We're going to get inflation data out of the US in about a week's time. We're going to get Canadian inflation data in a couple of weeks' time. Obviously, that's going to be important for interest rate setting policy. Canadian bank earnings. We just went through the Canadian bank earnings season. For the most part, those earnings were pretty soft. I think individual investors can take a look at these banks as perhaps a good investment idea going forward. We'll touch a bit upon that as well. And last but not least, US Treasuries. The relationship between the stock market and US government bonds still exists. As US government bond rates move higher, stock market moves lower. So inversely related. And that's something we see on a daily basis. Stock market moving inversely to government treasuries or US government bonds. So let's get started and move to the first point, which is Fed speak, or data on inflation. And we have a nice chart here, which we've shown many times, the US Consumer Price Index. And that really says it all. And you'll see here that the Consumer Price Index, 3.2%. In Canada, we're actually a little bit higher than that. But really what the Fed is looking at is this food and energy. What is the inflation rate, the core rate, less food and energy? And so this week, we've already had a few Fed officials speak. And I guess my comment on what they're saying is that they tend to be a little bit more mixed than they normally are. We've had a few Fed officials say that they think that where interest rates are right now is enough to restrict growth in the economy. It's significantly, restrictive enough so that they can see a slowdown in the demand for products, in the spending, to hopefully bring down inflation. And yet, I think as most recent as this morning, we heard from a Fed official saying, well, maybe one more rate hike is in the cards before the end of the year because we are still seeing strong inflation data. We received just recently, this morning, some information on services in the US, and it came in pretty strong. We also saw the price that on services that in the US right now is also really strong. So the prices on services is high, and therefore factoring into inflation. So we saw that the Fed, the percentage that we could see an interest rate increase, not in September, but in November, actually tick up to between 30 and 40%. So right now, there's a 30 to 40% chance that the Federal Reserve may raise rates in November. Very little chance that they're going to raise in September, but the chances are getting higher for a raise in November based on this strong services data. So overall, I believe that what the Fed governors say is even more important than what our Bank of Canada said this morning with respect to how the stock market behaves, both in the United States and here in our country. So we need to keep an eye on what Fed governors are saying. Second point that I wanted to touch on with respect to what investors should be focusing on when you make your investment decisions, as I mentioned, is Canadian bank earnings. Canadian bank earnings in general were pretty soft, right? A lot of the banks are saying lending is not as strong. What they're paying individuals to keep money at the bank is actually, or has actually gone up. So the spread between what they're paying on their high interest savings accounts, for example, and what they're charging on the loans they provide, that gap is starting to shrink more and more. And we've touched on this many times. Net interest margin is a key measuring stick for our banks. And many of the banks make a lot of money when they're able to charge more for the loans they provide and not pay as much interest on those savings accounts or those GICs. So with that in mind, with the softening in the banks, with the banks saying they're setting aside, more money for potentially bad debts down the road or people defaulting on their debts, should you be looking at Canadian banks as an investment? I think you can. But if you are going to look at Canadian banks as an investment, if you are going to put money to work in our Canadian bank sector, I think you need to be patient. I don't think you're going to see the growth right away. I think you're going to have to be patient and wait for growth down the road. How far down the road? Maybe 6 to 12 months. I think you're going to have to see the Bank of Canada and Federal Reserve stop raising rates before you're going to see the banking sector gain a lot of traction. So why do you buy them today? Well, number one, I think they're very cheap. Number two, they pay a fantastic dividend as a group. You look at RBC paying a 4.5% dividend, Bank of Nova Scotia paying a 6.7% dividend, TD Bank just under 5%, BMO 5%, CIBC 6.5%. Those are your top 5 banks paying dividends that, frankly, we haven't seen in quite some time. So I think you can own these banks and get paid while you wait for the growth to come. We have a nice chart here, which shows you, I guess, in general, how the banks have fared. We always show individual bank stock charts, but here, this chart, you can clearly see how our banks in general, the main banks in our country, the top 5, plus a few others in this ETF, you can see that they really haven't gained any traction. We've seen many ups and downs, but they've been pretty much range bound for quite some time. And I think for individual investors, you can extrapolate again from what the banks are telling us, how the banks are behaving. You can extrapolate that to how the economy is doing. And as we spoke about already, a slowing economy. And that's being backed up by what the banks are saying as well. The banks are telling us that they see a slowing economy as well. The banks are the bloodline for our economy. And so when the banks are struggling, when there's not as many businesses or individuals borrowing money to grow their business, when we're seeing the banks having to pay more money or more interest on the money that they want to keep, overall, this tells me that our economy is slowing down. And so banks, our economy, Bank of Canada, all goes hand in hand. So I guess my main message for our banks today is, yes, they are having a difficult time today, but that's when you want to buy them. You want to be a contrarian. You want to buy when those are fearful. And I think you can buy these banks because of the dividends, especially because of the dividends they provide, because you're going to make 4, 5, maybe almost as much as 7% dividends while you wait for the growth to come down the road. And I do believe it will come once we get by this interest rate hiking cycle. The third point I wanted to touch on that I mentioned off the top here in this segment that I think is important for individual investors to consider before you make your investment decisions, and that's U.S. Treasuries. And we seem to always have this topic or idea up for our show because it is really what is driving the bus right now. And I have a couple of charts here. 10-year U.S. Treasury. At the time this chart was taken, it was about 4.25. U.S. Treasuries, the 10-year has fluctuated. It's gone below 10% when the data out of the U.S. seems a little weak, and it goes above 4% when the data, like we saw this morning, out of the U.S. is strong. And so again, strong data, yields rise, stock market falls, unfortunately. And we're seeing today U.S. stock market and Canadian stock market, for that matter, Toronto Stock Exchange, falling in value. And as we know, sectors like tech stocks, the tech sector tends to take it on the chin more so than other sectors. And so we're seeing the NASDAQ actually fall by greater than 1% today because of higher yields, better economic data. We have a 2-year Treasury rate as well. The U.S. 2-year Treasury again here just below 5%, and that seems to be fluctuating on either side of 5%. We've seen it well above 5%. We've seen it come down when we saw some weaker data or weaker inflationary data out of the U.S. recently, and that rate has come down to below 5%. But unfortunately, we've seen it above 5% just in the last month or so. So going forward, I think before you make your investment decisions, I think you want to look at those 3 things that I've highlighted. U.S. Treasuries. What are U.S. Treasuries doing? What are interest rates doing? I think you want to look at Canadian bank stocks again. Perhaps You looked at them once before and moved away from them because of some of the difficulties that you're seeing. And lastly, I think we need to pay attention to what federal governors or the Federal Reserve governors are saying right now. Do we anticipate another quarter point hike in rates before the end of the year, or will they stand pat and let these previous interest rate hikes, run their course, take effect? We know that there's a lag when interest rates move higher. There's a lag. Some people say 6 to 12 months before we see it take effect on the economy. So I think it's important to focus on what these Federal Reserve governors say. And going forward, I think there's be some good opportunities in the month of September. I think you just have to, sharpen your pencil, make that list, and based on the 3 points I mentioned today, look for some good opportunities and keep an eye on what's happening, especially with respect to the Federal Reserve and Bank of Canada.